What is alpha in trading, and do you really need it to make money? Well, in this episode of Systematic Shenanigans, Pedmer and I dive into what alpha actually means and why most traders are completely wrong about it. And we want to share a surprising truth that most traders actually don't need any alpha to make some money in trading. In this episode, we'll also reveal critical differences between alpha and risk premiums and break down the exact approach to scaling your positions that allowed one of the largest traders in Sydney, Australia, to trade up to 20% of the daily volume in the Australian bond market. Let's get straight into episode 12. In this episode, I think the main topic we want to discuss is what is alpha in trading and do you actually need it to make money in trading? I think a lot of people, if you understand what alpha is, you might be thinking you actually do, but I think Pedmer has some actually thoughts about it. So I guess I'll let you start off on that kind of conversation.
Yeah, this is a very interesting topic because you see the word alpha being thrown around like all over on social media and stuff like that. But what really means alpha is not making money. Okay, so that's retail talk. That's not the true definition of alpha. There's a very good example. Not example. I don't. Yeah, the word doesn't come to my mind, but it was I first heard it from Hugh and C. Clare, and he explained it very visually and very well with an example. It's like this: like imagine that you are walking by the street near a bar at night, and you see like $100 bill on the ground that someone left it. They were drunk or whatever, and they dropped that $100 bill on the ground, right? And you pass it. You are the first one, and you take it. That is an example of alpha. You were first, you spotted an inefficiency, let's say, and you grabbed that money first from the ground. The only reason that you got that money is because you were first and you were there to extract it, okay? So that's an example of alpha. What's risk premium on the other side? Is, for example, you are on a highway and you see the same $100 bill, but in the middle of the highway, and you pass there and it's still there. Everybody has seen that $100 bill, but people find it risky and not worth the time to step out of the car, take the risk of being hit and getting the $100 bill, right? And that's a risk premium. It's something that is available to everyone else. It's there. Everyone can see it's there, but not everyone is willing to take the risk to get out of the car and to take that bill. So that's the difference between alpha and risk premium. And as Munir was saying, do you really need alpha to make money as a retail trader? I would say no. I don't say never because there's things that I've done that could be considered alpha, but most of my money has come from like risk premiums, like being willing to take risks that others aren't willing to take, and that I can take and that I can manage and that I can get paid for it. So that's the difference. What do you think, Munir?
I think you summed it up pretty much perfectly. I think that's kind of one of the best metaphors I've actually heard. I've actually, ironically, never heard it from Ewan Sinclair directly from him, but I think that sums it up really well. I'd also say, at least on the second part of that question, is yeah, a lot of my futures trading is pretty much risk premiums. I wouldn't say really any of it is pure alpha. I think in crypto you actually discover a decent amount of pure alphas. Now, not all of them are incredibly scalable, and I think that's one difference I would also say between risk premiums and alphas. This isn't always the case, but as a generalization, that risk premiums are often more scalable than alphas. Alphas are normally quite a lot more liquidity constrained, at least from my observations, because most of the time, if they're not, they're going to be arbitraged away quite fast, especially in today's kind of sort of market. It's not always the case, but I think most of the time it's pretty true. Would you agree?
I agree, but I think that yes, I completely agree with what you are saying. Alphas are normally very competitive. They are very short-lived in nature because it's like that example from the bar. The $100 bill is not going to be there long on the ground, right? Someone more sophisticated than you that is going to be there all night waiting for new $100 bills will be there, and they will be faster to take that $100 bill. But and sometimes people conflate alpha with risk premium because, for example, you see a new DeFi in crypto, a new DeFi protocol that offers you like 30% on yield on your stable coins. Like that's not alpha. That's a bunch of risk that is embedded on that 30% that maybe you don't understand. That is the underlying of that contract that you are getting paid for. That's why it's there and other people haven't taken it yet because it's so risky. And so it's hard not to conflate alpha, but they are two different things.
For the main point of the conversation, you definitely do not need these sort of alphas to make money in trading, especially you don't even need them to beat buy and hold returns, in my opinion. Now, a lot of the time, people are going to underrate, though, that to beat buy and hold returns, most of the time it comes from people using excess leverage and then not comparing it to how much they've leveraged. But when you even don't take that into account, you still can beat buy and hold through just like risk premiums.
Exactly. Most people say, "Oh, this guy made 1,000% in BTC or SPY only returned 100% or whatever." And yeah, you use 20 times leverage, so it's not that impressive, right?
Yeah, it's ballsy to do because obviously you're taking on a lot of risk, but ultimately, yeah, a lot of it just comes from leverage. Is there
Yeah,
anything else you wanted to note on that?
yeah. If I could add, like, take if I don't want to get too technical into this, but if you want to truly measure the alpha of your strategies, right? You take everything that is known, uh, buy and hold returns to keep it simple, other factors that influence returns on crypto that we know about, or in stocks, for example, stuff like value, size, volatility, all of this stuff. And whatever you have left of your returns, risk adjusted returns, I'm not saying you leverage your portfolio like we just said, that's your alpha. If you can't explain, or anyone can explain the source of your returns, they are not explained by momentum, they are not explained by anything else, you have alpha there. But the thing is, they are usually explained by something that people already discovered, and those are usually risk premiums. I'm not a worse trader because 90% of my returns come from momentum trading. It's not that doesn't make me a worse trader. It just means that it's a risk that I'm willing to take to extract some profit. I'm not a alpha trader. I'll probably never be. So you just have to find your own lane, in my opinion.
Yeah, 100%. I completely agree. For kind of my next topic, I guess this sort of goes into it. I did a thread recently about John Rambo. He was a really big Sydney, Australia bonds trader, basically. He did kind of the bond spread between the 3-year and the 10-year. Some days he was taking up, I think it was about 10 to 20% of daily volume size, which is just insane to think about. Now, obviously, that was back in like the 2000s or so, but still insane to think about. But one thing he said, which I think a lot of people kind of mistook as a very simple note. It makes complete sense when you think about it. His note was that his size only grew when the market grew, and that was primarily it. Now, obviously, that sounds very simple, but I do think a lot of people get into trading and they try and force a lot of size to scale up their P&L when they don't understand that most of the time the P&L is simply because of if the market is in a prime condition for that particular strategy. So trying to force, excess returns in crypto during a bear market, unless you're doing amazing short positions, that's going to be very difficult to do, right? So it makes more sense to size up when the particular market is either growing. So in his case, when the bond market was growing, he sized up during that because he was doing spreads. But for example, if it's a trend following market, you could increase your size as trend following is continuing to work, and that makes complete sense. And instead of just forcing it at random periods to try and make X amount of P&L because you have X goal that you need to hit. And that's why I always actually get quite frustrated when I see people say, I don't know, that you can make 10K a month as a trader. That's just like the most flawed way to look at trading, in my opinion. There is no one, well, very little amount of people in trading that you could say, hey, I'm going to make a guaranteed 10K this month. Unless you have something, as we described before, like an alpha that you could arbitrage for a while and hopefully it lasts the whole month, then maybe fair. But for the rest of the time, your returns are completely, random, at least in distribution side of things. So you can't be forcing sizing at worst periods, at least in my opinion. What do you think?
In regards to, you discussed there are two topics, right? The size of the market that you want to trade, and then the making money every month like it was a job. So let's start with the last part of the question, which is the making money every month like it was a job. Yeah, there are strategies that it really depends on the variance of the strategy, the sharp, everything like that. And it is not like a job. It's not like, okay, this month I have to make $10,000. The market doesn't care for that, okay? You are trying to extract a few things from the market, and they are not always going to be there. For example, you have a restaurant, right? A beachfront restaurant or whatever. I like to use that example. The summer months will be the best months for your business because your business will be packed. But there will be the winter months where nobody, when I say nobody, is compared to the summer months, will go to your restaurant, it'll probably be losing money. And that's the same thing with trading. Trading is a game where you lose a lot of the time you'll be losing money, and there's short periods of time where you make a lot of money. And this depends a lot on the strategy that you are using. So you have to keep that in mind. You can't force like the market, arbitrary numbers on the market. You take what is given to you, given the strategy that you use. In terms of the size of the market, I completely agree. You have to trade. For us retail traders, this is not a big problem. But for example, I was trading the other day on a new exchange in crypto, and they had like, let's say, $20,000 of open interest on a contract, on a futures contract, and I wanted to open a $20,000 position, and it's like I'm taking the entire open interest, almost no, I'm taking the entire open interest, and that might generate a problem for me if I want to get out, because I'll get a lot of slippage. It's a strategy that I was running, is funding arbitrage, and usually is very low. Like, it's very sensitive to slippage and costs because the returns are not huge on a unitary basis. It takes time to accumulate returns from that strategy. And so these are all things that we do have to be careful as small traders if we go to smaller markets. But yeah, you should always consider the size of the market that you trade.
Do you agree with the point of that you should size up only during like good regimes for your particular strategy or market, or do you size up at any time?
I don't think so. I don't think that people can that have much edge timing market regimes. I don't believe that.
Really?
Yeah.
Okay, well, I get where you're coming from because I agree to some extent. It's more that me saying that, let's say you're doing trend following, right, in crypto, because it's just a good example for you. It would be strange to size up 5x when you're at like 20% drawdown, no? Or like 50% drawdown if you're in like a clear bear market.
Depends. What if my positioning for a short is complete? It's like 100% of my portfolio. Shouldn't I be fully exposed to the market?
I guess I was putting in context there that you don't really take shorts, but
Oh, oh yeah,
like,
it's true. I get what you're saying. Yes, your positioning should reflect your confidence in the market, and that should be in your signal. Okay, when it's a bear market in my long only model, I'm not taking a fraction of the size that I'm taking on a bull market, right? But that's sorry, I was misinterpreting your question, but that's because of the model itself. It's not because
correct.
I say, okay, I am in a bear market, I'm going to take size off. I don't say that. If in a bear market they gave me full allocation tomorrow, I'll take full allocation. But it usually doesn't happen because my model is constructed in a way that my full allocation is taken when the market is very strong because I'm trading momentum. So yes, in a way, I do size my positions lower when there's lower confidence in the market that I'm trading.
Yeah, correct. That's kind of what I was aiming for, is that obviously you want to be systematic around it, but it was more around the conversation that a lot of maybe discretionary traders and traders I've also met try and they'll sit down for 1 month, they'll look over the reviews for their particular trading and they say, okay, like I want to try and make double the P&L, or I want to try and grow X by X amount. You can't really force that. It does need to be in line with whatever is actually working for your particular strategy.
Exactly. And I was thinking on more the retail way that I see people say on Twitter, like, oh, it's a bad market, whatever, going to cut half the size. And I'm
Yeah.
like, well, I don't see where you have an edge doing that, to be honest.
Yeah, no, completely. Like, actually, one good example of this. Now, this is technically quite discretionary, but it comes from a systematic route. I'll get to it in just a second. But I had to kind of cut my swing strategy recently for futures because it's primarily broken in the sense that Trump can tweet, and anything he tweets or anything that happens with his news breaks the strategy. It doesn't really fundamentally actually make sense anymore compared to the historical data. Now, obviously, during that historical data, there were going to be times where there was going to be news events and things like that, but at no period of time has there been a period where SPY gaps up 2% and moves 2% in a day for like 2 weeks straight, basically, just up and down different ranges. A lot of that is completely manufactured by one person tweeting, which I'm not having my opinion on that personally, but at least for a swing strategy, it's just not really possible because you're using data and historical data on something that's no longer the same environment, where this is a very unique case because I sometimes get asked the question of like, hey, does 2017 data really reflect nowadays, like current day's data? Which obviously it doesn't fully reflect it as there are different volatility periods and all those things like that. But that isn't a reason you shouldn't test your strategy over historical data because you still want a large sample size to see how it performed. And then you can also see how it would perform in that particular market if we did recess to less volatility for whatever reason. Or if it's like testing in 2020, it's good to see how it would have performed during that peak time. But obviously nowadays we're in a bit of a different environment. But in this particular case, if you're doing a swing strategy that's relying on overnight holds, you can't really get that risk anymore because it really can gap on you 4% in a particular night because he tweets that, hey, we have a deal with China or we don't have a deal with China. So that was just one thing that's sort of discretionary, but it comes from a systematic route of kind of managing a risk. I assume you haven't had to have that issue. I've been looking at crypto markets. They've been quite stable for the most part, actually been trending upwards. But have you had any weird risks because of Trump being involved?
Um, Crypto has been relatively stable, and also like my allocation is like we were talking about, it's mostly long like trend momentum models, and so it's very low frequency. So I was not very in that side. I didn't have too much exposure, but your point is very accurate. What you just said, because that's that's where a volatility like weighing, let's say, of the asset that you're trading comes into play, because let's say the SPY starts to become triple the volatility. It means that your position sizing should reflect that and should decrease in the same ratio as basically what I'm trying to say is that your position size should be inversely correlated to the volatility of the asset, and that will adjust. But yeah, once that volatility hits, it's quite hard to manage it, and that's true. But that's why we get paid to do this business.
Yeah, 100%. And then actually, my at least final topic would be, do you think it's easy to become a profitable trader by focusing on your strengths or your weaknesses? Because when I started out, I think a lot of my trading was trying to fix the things I was bad at, like discipline and emotional restraint and all those sort of things. But once I leaned into my strengths, trading became a lot easier, at least for me. But what do you think?
To be honest, I think that initially you should focus on what you're good at. Like I do think that, because that's how I did it. But over time, as you develop, you should really think about your weaknesses. And I've been thinking a lot about that, really a lot, because your weaknesses are everyone's weaknesses, in my opinion. Like, we are humans, most of us in the markets think the same way, have fears in the same way everyone has, greed everyone has. And if you think about your weaknesses, where you are most weak, and you try to exploit it, it might lead you to interesting conclusions in your strategies. That's at least one idea for it.
That's very interesting. I like that approach to it. At least like how I was thinking about it was that initial jump in progress, I think often comes from just focusing on strengths because it takes such a long time to fix weaknesses. And my approach for weaknesses has been, if I can fully eliminate that weakness, meaning that I take myself out of it, that is what I prefer. So like for me, execution was always a weakness. So I've removed myself from it with just automation. But then my strengths were modeling and being able to be more clear thinking when actually just creating strategies and researching and learning that process. So that's where I focused all my time, and that became the core strength of my particular trading. Whereas if like I was in the first year of trading, trying to fix my execution errors, trying to remain consistent with it, trying to not, whatever, ruin a stop or move a stop, all those sort of things, a lot of the time that was very slow progress to fix. Because even nowadays, me trading discretionary, I'm a bad discretionary trader. I've obviously got better over the past 5 years, but I'm still not what I would say is a top trader compared to some people I know that are just very good just executors. They're very solid. Like a great example for me is Lucas Shortbear. When you look at his trades and how he looks over his trades, he is a ruthless executor. He's very good at managing his positions, and that's just not a natural trait for me. So I just focused on my strengths, and that got me halfway there faster compared to trying to fix that particular one. So if you can remove yourself from a weakness completely, I think that's the easiest way. But I do agree, once you've got your initial boost from your strengths, it becomes more a matter of refinement. A good example of this actually is small caps. Small caps, the edge is very obvious. So the first boost you can do for small caps is shorting small caps for the most part. Longing them isn't as successful, though it does go through crazy cycles like recently. But once you've got that initial boost of understanding your direction, then a lot of it comes from refinement and fixing execution, doing filters and all those sort of things. I think that's quite similar to how it is as progressing as a trader, is you get that initial accelerant by focusing on your strength, and then you refine from there.
Exactly, I completely agree with you. I couldn't have said better. It's like you focus on your strengths and you do what works, but over time, as you become a better and better trader, I think that looking at your weaknesses deeply can bring you significant edge. And I'll give you a brief example. So I've been playing. We were talking about before you starting the recording before. I've been playing some very lucrative trades these past few weeks, and that has been like shorting the absolutely worst possible, like how can I say, short squeezes. So imagine that a coin, like any random coin, goes up like 100, 150, and 200%, and even higher. Okay, and you have something in crypto that is the funding rates on perpetual contracts. I'm not going to get very technical into it, but basically you are paying a fee to be short or to be long, depending on the premium of the contract to the spot price. And so imagine that some of these contracts can explode so much in funding that you can be paying like 2% every 4 hours. I'm saying 2% of your equity every 4 hours. So for example, if you have a $10,000 position, you are paying $200 every 4 hours. You are paying like 800 a day or something like that, more. Imagine that you are paying that every day for doing nothing other than bearing risk. And so I thought about it, and I was like, okay, what's the worst possible position here right now? And these things had funding at 2%, like I said, and they had extreme funding, and they were up like 200% and was squeezing the shorts. All of the shorts were getting squeezed. And so I said, okay, the most uncomfortable position right now is a short. That's the most uncomfortable position, and that would be extremely uncomfortable to take it. But maybe that's why I should start thinking about taking it. And okay, I took some data into those plays and I analyzed them, and it seems that I'm correct. Those plays, even though they have a very left tail risk, right? Some very nasty losses, but they give you very high odds returns. Like every trade that I've taken so far of that type of strategy has been a winner so far on every position, and quite juicy winners. Like I'm talking 30% and 50% winners. Just for me thinking on one of my weaknesses, that is mean reversion and shorting really volatile crap, and that's one idea.
Isn't that I'm not saying it's the exact same, but it sounds very, very similar to the classic hedge fund blow up story, of the sense that hedge funds become so big taking left tail risks, and then once they have, multiple hundred millions under management on a particular position, if they do blow up on that, then it's overall the bank's responsibility, and the hedge fund gets to work away with like big bonuses from all the previous years. So it's just like a classic strategy of that. It's sort of similar, right?
I wouldn't get a bonus for blow up though.
Well, yeah. I'm just saying it's a similar approach, if that makes sense.
Yeah,
Is that you have a very, very big, like there's a very chance that you blow up huge, but you do get incredible returns in the meantime.
exactly. It's just like a micro cap stock short, right? You are
Yeah.
taking shorts every morning, like on those 20% spikes or whatever. After it caps up 50% or 70%, you are taking the short, and sometimes that stuff turns into a GME or something like
Yeah.
that, you know?
Yeah. It's interesting. I like it. I like it. I think the one best thing about knowing you as like a trader is you just always explore stuff. You are, I think we talked about it before. You're definitely one of those kind of journey people where you like the journey of exploring different new things and you really like new ideas. I think for me, I'm a bit more of a boring trader. I don't really explore that many new ideas. I always do research, but that's because I think I find research engaging, but I don't think I deploy enough on like new ideas. But definitely getting into crypto more, it's been an amazing awakening of like being able to test ideas really fast, and there's just so many things to test. It's really nice environment to do it. Now obviously you have those infrastructure risks, but I do see why a lot of the best people in the world are, doing some inefficiencies in crypto compared to other markets because it's a lot of fun to research.
Yeah, yeah, exactly. But I do think that you're selling yourself a bit short because this year we've taken a lot of different trades. Don't forget about that.
I guess that's true.
Yeah.
That's primarily because of you, though. I wouldn't say it's fully just because of me, but yeah, no, that's fair. That's fair.
The- but I wouldn't also like romanticize my own like risk taking because a lot of times I'm spending time on things that I'm not focused on my own strengths, and that's not always good, you know. So it's I enjoy the game of trading. I enjoy thinking, but it's not always good. For example, we just stopped the call, right? Because I got liquidated and I wanted to rebalance my other leg of the position. And I'm watching these charts as we are doing the podcast because my liquidation is right at the top. So I'm already thinking, okay, I know why this happened. Like the funding was extremely positive, exactly the reverse of what we just talked about. The funding was extremely positive, so I was harvesting that funding. I was short on Hyperliquid and I was long on Binance Spot. So I had a delta neutral position to harvest that extreme funding. But obviously, everyone was doing the same trade that I was doing. We were all harvesting the funding. And what happens? Surely you get a short squeeze. And now the price is dumping because everybody was stuck short. And I'm already thinking, okay, how can I revert this behavior? Can I profit from this the next time? I didn't lose money. Like for context for you, for listeners, I get liquidated, but I have my leg, the spot leg, I was delta neutral. So I was just harvesting the funding. But it's interesting, these dynamics to me, and this is how I find new ideas. I just go into the markets and I put capital in and I test new stuff.
You know, one thing, this like you're kind of a masterclass in this because I talked to some traders recently, and if they're listening to this is no hate at all to you guys. You have amazing strategies, but some of them really are a bit nervous about putting the strategy live, and they kind of like constantly like to tweak it or think of something new they could add to it or some other test they need to do. And like while obviously there were some things they should have tested and I kind of helped them test those, ultimately at the end of the day I was like, you're gonna have to set this live, like you're going to have to forward test this. You're gonna have to put it on a small amount of capital and you're gonna have to be willing to lose some money. You could be wrong, your time could have been slightly wasted. Obviously you still would have learned things from the process, but a lot of that is having the courage to go out there and test that idea. And I think it's very admirable that you're always thinking of a new idea, and it's not just that you're thinking of a new idea to test. You actually take action and actually do it, which is primarily one of the most important steps.
Yeah. I think that a lot of people take too much time, like theorizing about new ideas and strategy and stuff like that, and that's fine. Being cautious, it's fine, but at some point you have to go into the markets. You get the experience, like understanding the volatility. You want put it basically like you won't get the experience of going through a day where SPY crashes 5% in a single day just by looking at the backtest. You don't know the emotional weight of that. You have to be there,
Yeah, no, it's very, very true. All right, we probably have time for one more topic. What one do you want to pick?
We are in a people like strategies here, so maybe
Sure.
what it's like managing a multi-strategy crypto portfolio, because I've been pretty deep in the weeds of that.
Sure, go for it. Let's hear it.
Yeah.
Yeah.
So lately I've been running a bunch of different types of strategies. Like I've been running like delta neutral funding arbitrages, stake yields on chain, my own momentum strategies, those type of mean reversion, some discretionary trades, stuff like that. I've been running a bunch of stuff at the same time, and I have like I had tons of wallets across a bunch of different things. And when I wanted to say, okay, how much money did I really make from this funding arbitrage type of strategy? I'm spending like 3 hours a week or 4 hours a week rebalancing positions, putting on positions, taking on positions. How much am I getting compensated for my time here? And the truth is, I didn't have an answer. I didn't know how much my portfolio was up because I tracked the balances every day. I knew how much I had money on, but I didn't know where it came from. And that was starting to become very hard to track. So I had to develop a new system that I just finished yesterday. This is like I have an Excel with all the wallets, every wallet has a different purpose. So for example, I don't have a wallet for funding arbitrage and then for discretionary trading. I don't have that. I have one wallet for funding arbitrage and one wallet for discretionary trading, so that I can keep track of the balances there. I keep track of all the deposits and withdrawals that I do every day. For example, I have to move money from stable coins, from my stablecoin wallet to my funding arbitrage wallet. I record that so that you can track, like, okay, I had $10,000 here. I added 10,000 more. So that's not PNL. That's the delta between the withdrawal and the PNL you had the previous day is the PNL. And so you keep everything very tidy. Otherwise, you lose complete track of everything, and you don't know where your returns are coming from. Yeah, that's been my experience.
It's a very unique issue to have, because like for most, well, I guess I sort of have the issue a bit now because obviously I'm trading a bit of crypto, but primarily everything's just in one brokerage for me for futures, and then I just have to keep track of like margin requirements and all those sort of things and drawdowns, and then I have a bit of crypto as well. But I will say, as you manage more strategies, for me, it's been more technical. I would say like the technical infrastructure issues, which haven't been that difficult, but that's been probably the only kind of growing pains of running more strategies. Is like NinjaTrader is great, but when you're trying to run 10 plus strategies, and if you're like backtesting something as well or whatever, it starts to get a bit slow. So you'll need like different VPSs or a different amount of CPU cores to make it run okay. But apart from that, it's been overall pretty good. I will say this is one good lesson, is if someone's trying to run a lot of automation strategies and they're trying to custom build everything, it's a big task to kind of like fix. There's a lot of optimizations once you get to running that many orders. It depends on the time frame, but at least from experience with working with some people, if you're running like 20 strategies and they're automated, you're going to need some serious infrastructure to kind of like fix that out and actually make it all work.
Yeah, but I do think like if you're running like that type of strategy, like 10 strategies or whatever, you still need to track like the balances of each strategy, how much PNL is coming from individual strategies, because you need to know what's truly generating PNL and what's not, what to keep on, what to keep off. So there's a bunch of things that you still need to track even within one wallet or one exchange, whatever.
That's fair. I actually do use a tool. I think it's called Quant Analyzer. I
Yeah.
found it a month or two ago. I use that, and I kind of plug in all my trades, and I can see it. And it's also what I use for if I do like monthly recaps on YouTube, because I just plug in all the trades, and then it kind of splits them out into like different equity curves, which is really useful. So I think things like that, yeah, I definitely agree. It's a good thing to track.
And for example, if you are running like for example, different a trend following model, but with different signals. For example, you are trading a Bollinger Band, a semi crossover type signals and stuff like that. I still think it's good to track what's the edge or whatever you want to call it of each of the signals that you are trading, and see what kind of information it is adding to the overall model and stuff like that. So there's a lot of individual trackings that people still should be doing, even if they are running from one broker. So I think the principle still applies. You will really have to have your numbers really dig down if you want to truly know where the money comes from. Or you don't care. You just care about you made money or you didn't make money. That's maybe fine too.
Yeah, I guess
Yeah.
fair.